Inflation remains a hot topic in financial markets at present as investors study the effects of huge government stimulus programs, rising commodity prices, and supply chain pressures caused by the reopening of Western economies. Now, headlines abound with examples of price pressures, and in April, we saw US inflation rise at its fastest pace since 2009. So, should we be worried about inflation? Well, the short answer is that it's logical to expect a spike in inflation in the near term. Inflation is calculated by referencing prices today versus those a year ago, when the global economy is in the depth of a lockdown and inflation was low. And so there are base effects at play here. But the reopening of economies has also resulted in mismatches between supply and demand that in turn will produce price pressures. We see this in the detail of last month's inflation data in the United States, where the sudden return of demand in the airline, hotel, and used car sectors has led to supply bottlenecks and stoked price pressures. But we expect many of these types of bottlenecks to be temporary rather than structural imbalances that persist. So what about the medium term? Well, central bank policy has been enacted to stimulate a healthy level of inflation. And so we expect inflation to normalize from its previously low levels, again with some temporary overshoots of inflationary targets as we work through the reopening stage, but not to normalize at levels that are significantly higher than those central bank expectations. That said, we're not complacent on inflation risks, and whilst we can't hedge inflation risk entirely, our portfolios are currently positioned to accommodate higher inflationary pressures. We remain overweight equity assets, underweight government bond assets, most sensitive to inflationary forces, and we also hold gold as an additional inflation hedge in our portfolios.